Welcome for our lesson today. Let's go. We will learn about the interconnection of financial statements. What is this? How the balance sheet, income statement, and cash flow statement form a unified system, and why understanding their links in the foundation of financial analysis. What are the financial statements? Statements. A financial statements are structured documents that present a company's financial performance and position. They are governed by accounting standards and serve as the universal language of a business. The balance sheet, the income statement, and the cash flow statement. If you talk about financial statement, you must have your balance sheet, your income statement, and your cash flow statement. The balance sheet, what is this? This is a definition and a formula. Balance sheet capture a company's financial position at a specific date. It is built on a fundamental equation that must always balance. That means your asset must equal in your liability plus equity. What is the income statement? This is a definition and a formula. What's the measures? The income statement shows profitability over a period, month, quarter, years. It tracks how revenues are transformed into net profit after all expenses. This is the formula. Net profit equal revenues minus expenses. And the third, what is the cash flow statement? This is a definition and a formula. The cash flow statement tracks actual cash movement during a period. Unlike the income statement, it's in your accrual. Only real cash in and out count. The cash flow statement contains the operating activities, the investing activities, and the financing activities. How the three statements connect. The three statements are not independent. They are deeply interconnected. A change in only automatically affects the others. This is a few images show how the three bases interconnects. Net profit, flow to retained earning, capital expense, ending cash, ending cash flow statement, debt insurance. That is funding about your financial hub. Net profit, depreciation both, cash balance sheet. When and why to use each statement. A balance sheet assess financial health, solvency, and leverage used by lender and investor to evaluate risk. Income statement measure profitability and operational efficiency used to compare performance across a period. And the cash flow statement verify liquidity and cash generation critical for detecting if a profitable company can actually pay its bill. This is a theoretical example, step-by-step calculation. Let's follow a sample transaction from all three statements. A company sells goods for $1,000 cash with a cost of 600,000 $600. This is a sample graph. The income statement impact the revenue 1,000 and the cost is 600. So we have 4,000 net profit. The balance sheet cash 1,000, investor 600, equity 400. And the cash flow, operating cash flow is $400. You see, the three statement is interconnect and not using only. You, you must use all the three together if you like to make a financial statement. This is a real-world example. Apple Inc. 2023. What's the number tell us? Apple generated $383 billion in a revenue in 2023, with an operating cash flow of $110 billion. The income statement shows strong profitability, which followed into retaining earnings on the balance sheet, now exceeding $200 billion. What is the key insight? Apple cash flow is consistently lower than its net income due to heavy capital expenditures and inventory management. A classic example of why all three statements must be read together. What is the expert advice? How to get the most out of financial statements? First, always read all the three together. Focus on trends, not snapshots. Third, use the ratios to connect the dots. And fourth, finally, question the accruals. That is the lesson for today. Thank you, everyone. And don't hesitate if you have a question, write in the comments. See you soon.